All right, so let's flip to the next tab, which is now the investment tab. Okay. All right. Investment theory. Okay. How many people have taken a finance class in school? Just you guys. Okay, so there's a whole fleet of you over here. All right. The key concept in finance, if you just want to sound like you know what you're talking about in finance, you just talk about risk and return. That is like the major theme of finance is risk and return, okay? And everybody knows what a return is, right? What's an interest rate you get in the bank or an investment, right? Like 5% or 10% or 2% or 1%. So the returns are pretty easy to measure. So how many people have heard how much they made, someone might have made in the stock market, 10% or 15% or 20%. So returns are very easy to understand. But risk, okay, so it's risk and return. What is risk? Okay, you took a risk to even drive here today. Okay, but how do you quantify risk? It's harder. And so I tried to break risk down so you can understand what risk is in the concept of risk and return in the finance world. But here's on the left-hand side. Let's just go at the bottom down there. It says cash in the bottom left-hand corner, and it says low risk. So there's not very much risk there. And see the 1% underneath it? Is everyone to that screen? So basically it says if you have cash and you don't want to take on much risk, you might get 1% return. Okay? But now let's go up a little bit and let's say you're going to buy some bonds. You see the next box is bonds, and the next one is annuities, and the next one is mutual funds. As you buy different kinds of products, those are investment products. Bonds is an investment product. You can buy savings bonds. Has anyone heard of savings bonds? That's a bond, okay? You can buy savings bonds, corporate bonds, municipal bonds. Do not buy Detroit bonds if you're up on current news, okay? Because here's the danger of a bond. The bond is only as good as the person or area or company that issued it. And so if the federal government issued a bond, which they do with savings bonds, is the federal government going to go bankrupt? Probably not. Probably not. It's going to bring you up to some sequester where they're going to then just authorize more money to get built and they'll just pay for it. So, however, if you bought a bond, and a lot of bonds were done, because did you hear how much debt they had? It was numbers of billions. In order for them to have billions of debt, that means they put out billions of bonds. And somebody bought those bonds, okay? And when the city goes bankrupt, that means those bonds aren't worth what they used to be. More than likely, it means they're not going to be worth a whole bunch, okay? And so it's one of those things that bonds are only so there's risk there that you might not get your money back, okay? But you're going to make a higher return. You might make 4%, 5%, and then there's things called junk bonds. Has anyone ever heard of a junk bond? There used to be a whole junk bond thing going. You can make 15% or something on a junk bond, but a junk bond says, we're going to go to this company, and they are a company. They're legitimate, but they're sort of sketchy. But they're willing to pay me 15% if I give them $10,000. And I know the guy, so I'm going to try it. All right, that's sort of like a junk bond. A junk bond has this sort of sketchy relationship for this company that wants money, and then when they take the $10,000, you're hoping that company's going to pay you back. But when they pay you back, they're going to pay you back with a lot of interest on it. All right, so junk bonds are lower quality bonds that have higher risk because that guy might just take the money and go down to the Bahamas, okay? But they might pay, and then you make a lot of money, all right? And so bonds have a risk. Then annuities are with usually insurance companies. So if you're ever approached by giving money to an insurance company not for insurance, it's probably some kind of annuity. An annuity means you give them money, and then they're going to give you a certain amount back each month at some period in time for the rest of your life or for some period of time. And so a lot of people do that for retirement. They'll give the insurance company a bunch of money. The The insurance company gives them a guaranteed monthly or 5% number over a long period of time, and so it's just another type. But if the insurance company would go under, so would that annuity. Okay, so there's risk there. Okay, then there's a thing called mutual funds. That's the stock market, and then above that are stocks. And stocks have the highest risk, theoretically, because a stock is for one company. A mutual fund may have 100 companies in it. So a mutual fund is just 100 different company stocks, and 100, don't take me literally with 100, but it's a whole mess of stocks in a cluster called a mutual fund. And then a stock is one company. So does anyone know anybody in town that used to work for PMSC that then turned into Mind, that then turned into CSC? Does anyone know those names? Okay, the way they did their retirement at PMSC was their retirement was in PMSC stock. Okay, so then when they went under, their stock price went from $75 down to $15. Everybody lost their retirement when that happened, and then they got bought out. And so everyone's retirement just got thrown out with that one company when it went down. And so when you have one stock and it goes under, that you don't have any more money. It just went away. And so there's risk when you just get one stock. You got to pick a good horse that you know is going to weather financial storms when you buy one stock, okay, or one company stock. Okay, a mutual fund says, I'm going to pick a cluster of companies that are all good, but then if one goes bad, there's 99 other ones in here that are good, and that will protect me. So mutual funds have less risk because it's diversified to a lot of different companies. Does that make sense? And they have a mutual fund for everything you can think of. They have a mutual fund for just Australia companies, or they have a mutual fund for just insurance companies, or a mutual fund for just banking, or just energy, or for just automobiles, or for just whatever. So there's a mutual fund for everything: real estate, transportation, health services. So you can buy, and again, those mutual funds, that's a cluster of companies that do just that. The definition that is really a law that they have to obey is when they set up the definition of that mutual fund, by law, they can only buy companies that meet that definition into that fund. So if I have a real estate mutual fund that I'm in, they can't go buying an energy company stock in there. Even if energy stocks are going off the deep end, booming, they can't buy that or they'll go to jail. Okay? And so a lot of times, so when you buy a mutual fund, you're sort of protected in that it's only going to happen what you say you're buying into is going to happen in that fund. Does that make sense? So the concept of risk and return. But now risk is still sort of hard to figure out. So let's go to the next tab.